Hello everybody, this is Richard Pears. Thanks for joining us all today. I'm representing Finextra on our Sustainable Finance.Live event, and thank you very much for bearing with us. Of course, this was initially a physical event which was going to happen back in March, and we've redesigned it and repurposed it for this digital format. We're very excited to bring it to you in this format, and I'll be explaining it to you in a little bit more detail in a moment. You'll notice with this format, unlike many of your Zoom and Teams calls, that it's not a sort of sea of faces. We actually are just broadcasting using Teams.Live. Tomorrow in the workshops we'll be using the normal Teams collaborative tool, but for now you'll just be seeing us as you do now, a talking head and the slides. But let's start. Let's go on to our next slide and introduce our panelists for the day. Myself there, Richard Pears, and we also have Maya Hennickes, who's from the European Bank for Reconstruction and Development. She's joining us today over the telephone as the mixed technology that we're all getting used to works. So hi, Maya.
Hi, Richard. Nice to meet everybody. Thanks for having me.
Yeah, we're looking forward to hearing from you later. We've got Keith McGrain, CEO of Core Energy. Hi, Keith.
Hi, Richard. Good morning, everybody.
Great. And Keith, there we go. We can see your video, so we can see Keith.
Hello.
And we also have Elena who's joining us, Elena Filipova, who's joining us from Refinitiv. I'm sure many of you will know Elena. Hi, Elena.
Hey, Richard. Good morning, everyone.
Fantastic. Good to see you today. So let's get on to the purpose of today. And I just want to say to everybody, first of all, we're trying to take this in a style which is a little bit different. We've asked everybody on the speaking side to give us a challenge, if you will, not just to sort of turn up with the corporate approach, but sort of bring the challenges of investing, of asset management. And obviously Keith will be representing the investee perspective. We've got Elena representing the data perspective and Maya representing the investor perspective. So let's have a look at the next slide, please, which gives us our agenda for the day. I'll be starting as we have already kicked off, and I'll give you a bit of a run through of the overall process as well in a moment, before handing over to Keith. And Keith is going to give us really the perspective, as I've said, as the challenger looking for that investment, which is really going to help change the world in a positive way. Maya's going to respond, representing EBRD, but also the voice of the banking industry in how her response will execute, and Elena helping us look at the data side of things, which, as we know, is one of our always interesting topics in sustainable finance and ESG. We'll then jump into our panel, which I'll be moderating, and of course we'll be looking to bring you into that at that stage. So if we can have a look at our next slide, I'll tell you how you can actually get into it. You'll see here, this is just a dummy screen, obviously, and the content will be populated as it is now. But over to the right there, you'll see the Q&A panel. I'm sure you're all very familiar with these now from many of your digital interactions over the last few weeks or so. So just fire your questions in there. They'll get sent through to our moderator and they'll publish out the ones that we'll be looking at as the event goes on. So let's just test whether that all works. If we could look at the next image. So let's have a look at that for a moment. Think about that. Where does that come from? And I'm going to ask you a question just for a bit of fun, just to see if the technology is working. So if we look at the question panel, the question from us is this a product session at the famous Dyson vacuum cleaner company, or is it B, Apollo engineers putting a square peg into a round hole? So have a look at that if you would, and give us an answer, and we'll just see whether that is resonating with you, whether you found the way to the tool button, whether our moderator can indeed fire through the results to us there. Now, as you know, it's an interesting image, probably. I'm sure you've all probably started. I can see the answers coming through now. We've got 3 or 4 there. There we go. Everybody knows it's Apollo 13. And an interesting example, perhaps, because in a way I feel it sets up what we're doing today. There was, as you recall, a CO2 problem in the movie. There was, if you recall, a lack of standards. There were square things, round things. They didn't fit together particularly well. And then there was a team of people who got together and worked to find a solution, which was to get people back on the ground. Maybe a little metaphor for our event today. If I could have the next slide. Looks like everybody's found the Q&As. And what I want to do is to just briefly tell you how we came about this activity today. So the next slide really sets up our workshop for today and for tomorrow. Sustainable finance, as I know many of you are finance professionals and will know all about this. So we're not going into great definitions, but I love this one from Sir Roger Gifford, who is of the Green Finance Institute and various other institutions, as many of you know, where he talks about sustainable finance is both risk mitigation, it's about obviously profitability and allocating finance. And this work here, as he says, if we allocate this finance carefully, it is less risky. And indeed, in many ways, what we've seen with the performance of a lot of sustainable finance portfolios is indeed they perform very well during the current crisis. We also, I think, all know of these headlines, $30 trillion of capital, various numbers bandied around that are being aligned and allocated to sustainable finance. But I think, as we know, there's a difference between an allocation and an investment. And this volume of capital I like to think of as a huge dam of water, if you will, a dam of capital trapped back behind a wall, which isn't trickling downstream to feed the projects that basically need it necessarily so that we can advance the goals of achieving 1.5 degrees and less. So we know that's our context of sustainable finance. And if we go on to the next slide, what we're trying to do with these workshops is not talk generally about the problems, but we want to lean back, listen to our practitioners as we have today, such as Elena, Keith and Maya, tell us about some of the challenges that stop that capital flowing down to interesting projects like Keith's. We would then want to lean in with them and ask further, interrogate them about why that is, what's their experience, what's the challenge in the value chain that makes that happen. And then we want to learn by doing, and that's what tomorrow is all about. The learn by doing sessions really follow as a result of today. Today is not an end product in itself. It is about then getting into those design workshops where we have a team of experts who will take us through the process of trying to resolve some of those issues, put it into a visual record. And with that visual record, you can take that back to your offices and hopefully start to crack on solving some of those challenges. We can put that out to the open source community, we can put it to the academic world, and we can start to see if we can take the insights of you and our speakers to advance our message in this particular area. So if we move on to our next slide, this was, I'm not going to unpack this one at all, but I want to just begin with the end in mind. This was an example of what we did at our last workshop in December, which was for commercial banking around green bonds. And the team in the workshop, and hopefully you'll be involved in them tomorrow, sat down and looked at what was going on with green bonds. They looked at why there's more demand than there is supply, what the friction was, and they went through this whole process of whiteboarding and design analysis to come up with a new business model canvas that we could think about working. So I just want to be clear, we're beginning a journey here with this discussion. So let's have a look at our next slide. Our first speaker is Keith McGrain from Core Energy. Keith is the CEO and a renewables entrepreneur, but he's also been in the finance industry. He's been on the side of project finance. He knows both sides of the coin. We have him here today starting our conversation because we love to get an exemplar, somebody that represents not just their own company, but a whole class of assets, somebody out there who can help change the world, but is looking for that capital that we want to be freed from behind that dam. Keith is going to take us through a great opportunity, some of his frustrations, then we'll be hearing from Maya and from Elena. So Keith, I'll get out of the way. Over to you, sir.
Thanks very much, Richard. Good morning, everyone. As Richard said, I'm the CEO of Core Energy, and delighted to be presenting today to you all. A bit of background on myself. I've got 20 years, close to 20 years experience in renewables development, including financing, mostly in wind farms and energy storage. And the past 10 years has been focused entirely on pioneering the development of compressed air energy storage projects across Northern Europe. That journey started for me in 2008 and really accelerated in 2010. So you can see how long I've been trying to commercialize these types of systems. And it was in 2017 that we formed Core Energy, which was a spin out of the energy storage division of an Irish renewables company called Galectric. And the problem that we're trying to solve in Core Energy is what I describe as the integration problem associated with high penetration levels of variable renewables. We look across Europe and the world for that matter. Most countries are now moving towards 70% renewables by 2030. When I started my career in wind wasn't even an industry, it was a movement, and levels of 10%, 20% were seen as unachievable. Now we're moving to 70% on the pathway to 100% renewables. And it's likely that some countries on the back of the EU Green Deal are going to reach towards 100% by the end of this decade. So these are unprecedented targets, and that requires very big energy storage solutions. And so as a company, we have focused on large capacity underground energy storage that can provide long duration storage. And those systems are needed to enable these very high levels of renewables. And it addresses the underlying issues associated with getting to those very high levels. So as you move from low levels of renewables to high levels, you start to see a number of major problems manifest themselves on an electricity grid. You see increasing levels of curtailment of wind farms and solar farms. The grid can't absorb these levels, and so system operators, to maintain the security of the system, actually have to turn off at an increasing rate wind and solar projects, which is a big issue for investors. Investors that are moving away from subsidized renewables into unsubsidized renewables have to bear these new levels of risks on the system. And this is where these technologies come into their own in terms of providing business models that can enable hedging of those risks and also manage the system security, keeping the lights on and providing renewables in a more affordable way to end users. So I hope that gives you some background on myself and what we're doing in Core Energy. I'm very much looking forward to bringing you through the presentation today and honing in on the problems that I wake up on a Monday morning, Tuesday morning, every day of the week and every weekend, thinking about addressing this financing gap that we have to solve together. So let's move to the next slide. So bringing us through the presentation, I want to talk firstly about the storage market itself. I mean, storage and storing electricity has been around for a very long time. There's a range of technologies. I think all too often we're looking for a one-fit-all solution. That's not how this market is going to bear out. So I want to talk about how technology fits at different stages of the integration of renewables as we move to these unprecedented levels of 70 to 100%. And then explain the advantages of underground storage. And I'm going to show a map that it illustrates the distribution of salt deposits that can allow for underground storage projects to be developed at scale. And there's an interesting coincidence between where we're building most renewables, that is offshore wind, and the existence of proven salt deposits for underground energy storage. Then I'm going to move into explaining compressed air storage technology, a technology that has been around for a long time. It's actually operating for over 50 years, but finds a novel application as we move to these high levels of renewables. So I'm going to explain the technology in more detail. and then describe the project, our flagship project in the Netherlands, for which the European Commission is an anchor investor. And then something that I find the market is relatively unaware of, even policymakers, and that is, well, what's the system-wide impact of large-scale storage in a country that is seeking to achieve these high levels of renewables? And that's an assessment that we as a company have carried out over many years in conjunction with major institutions such as the European Commission, research institutes all over the world, the National Renewable Energy Lab in the United States, and it's the understanding of the value of storage that has to be related back to market design and how market design has to evolve. So I'm going to go into that in a reasonable amount of detail, because that helps us then narrow in on one of the major problems, that is market failure, and then how that is concentrated in terms of a problem raising financing, the gap between when you originate your project, you get it through initial feasibility assessment and into the mid-stage development, you tend to get stranded, whereby the market won't invest to get the project to financial close. And it's a pervasive problem, and it's not just related to energy storage, it seems to be right across the infrastructure asset classes in the renewable sector. And what's the cost of not solving this problem? Now, the opportunity cost is very, very significant, and there's some major work that's been done by Imperial College London on this, and I want to share that just to show to people what is the true cost of not solving this problem. So that's the agenda, and we can move on to the next slide. So this illustration, what it seeks to do is to break down the storage market in accordance with the duration of storage that's required as we move through the different integration phases of renewables. So if we start on the right-hand side, we have seconds to minutes. That's related to low levels of renewables penetration of 10 to 30%. And that's where renewables are meeting 10 to 30% of the average annual electricity demand across any one year. And when you see the impact that those level renewables has on the grid, you require controlling the voltage and frequency of the grid. So you start to see increase and decreases in frequency of the system, and we know that electricity systems have to maintain a balance between supply and demand, and in Europe that's traditionally 50 hertz. And we also see the need to provide very fast response contingency. So if we lose a plant, we need something else to come onto the system very, very quickly, within milliseconds to seconds. And battery technology, as has been seen in the UK under these contracts with National Grid for enhanced frequency response, is a very effective provider of that fast response capability. So in the earliest stages of increasing renewables, that 10 to 30%, we see a need for frequency management response technologies, and battery is a very effective provider for that. When we move into much higher levels, and we're talking 30 to 60% renewables, what we start to see are very long periods where the wind is not blowing, or for that matter, the sun is shining too much, which is a problem in sunnier parts of the world. But as you can see across Europe over the past week or so, in the past few weeks, the weather has been tremendous. And so, battery in the longer duration windows is not as cost effective, and it struggles to get to the same scale that compressed air storage technology can be delivered on. We're talking hundreds of megawatts of storage, and we're talking durations of minutes into days. So many hours of balancing will be required, and we could have periods of 24 hours where we've got very low levels of wind. We want to avoid the need to bring on conventional power plants to provide that backup, and so we should be using large capacity, long duration storage systems. And so compressed air provides that continuous balancing, that integration service, and greatly reduces the need to curtail wind and solar farms, which if you don't have storage, tends to be the default position that system operators have, that they have to turn off these projects. But as we move then towards 60 to 100%, and this is a place that we're going to find ourselves towards the end of this decade and into the early part of the next decade, is we need much longer duration storage. So we need to move to a higher energy density fuel, and that is seen as hydrogen. I think the past number of months have seen accelerated interest in renewable hydrogen, and recently last week on Wednesday, the European Commission announced its recovery plan post-COVID, and the energy transition is front and centre of that, and clean hydrogen is going to realise a number of major funding instruments from the European Commission, European Investment Bank, and for that matter, they're going to look at a whole incentive framework around stimulating investments into hydrogen, that being hydrogen production, utilisation and storage for that matter. So we can use the same caverns that we designed for compressed air storage, we can also put hydrogen into these caverns. And the cost of using a cavern for hydrogen storage, it's 100 times cheaper than a battery for the equivalent duration. So you know, the point that I'm making here is that it's not a one-fits-all technology solution. There are different technologies that have respective roles to play as we go through the various phases of renewables integration. And so it's a complementarity picture that we paint, rather than there's only one solution to fix the problem. So let's move on to the next slide. So why underground storage? This is a map of the distribution of salt deposits represented in green across Northern Europe. And you can see right across the northern parts of Ireland, through the UK down to the southern part into Portland, and right across Netherlands, Denmark, Germany in particular, and in the offshore regions, we have significant amounts of salt deposits. And most of the gas storage in Northern Europe is actually held in underground caverns that are solution mined from salt. And we have this happy coincidence that I mentioned earlier on between the resource of the North Sea in terms of building offshore wind. We're moving from fixed foundation offshore wind turbines being 5 megawatt, increasing to 10 megawatt in size, now into floating offshore wind, and even floating solar is proposed off the coast of Northern Europe. That the majority of these targets are likely to be met by offshore resources, predominantly offshore wind. And we don't have topography, a mountainous topography in Northern Europe that would allow for a very well-known and proven form of very large-scale electricity storage, and that is pumped hydro storage, where we're pumping water up and down a hill and to create that electricity storage effect. But what we do have, we have proven brownfield sites that can facilitate several hundred caverns that can provide both air storage and hydrogen storage across Northern Europe. And there's a very good distribution in Southern Europe as well. So it's not a limitation of salt deposits. And we as a company, and I've highlighted in the various blue circles there, projects that we have currently under development. What I mean by the annotation there with the blue circles, you can see PCI and TYNDP. Another problem you have to solve in this industry is the amount of acronyms we use, but PCI, what that stands for is a project of common interest. And a project of common interest is a designation provided by the European Commission. That designation provides for priority status for the project within a member state. It means it must be delivered in conjunction with the private project promoter. It also allows for accelerated permitting of the project, so the national authorities have to ensure that they guide the project through the permitting process. And you can also provide for major grant facilities to be secured, so up to 50% of the development costs and construction costs of the projects. So we are developing major facilities in Germany, Netherlands and Denmark, and our flagship project is in the Netherlands. Our anchor investor is the European Commission. I'm going to go on to the next slide and talk about the technology in more detail. So this is a schematic of the compressed air storage technology. It's a proven technology with over 50 years safe operation demonstrated in Europe and the United States. First project built in 1978 in Germany. As I said, it provides long duration storage. 24 hours and even 48 hours can be realized using the technology. And that's going to be critical in achieving these targets by 2030. And the impact of the technology in the system, I'll come on to later on, it's very significant. We call this the salad bowl of the compressed air storage technology. And how it works, its principle of operation is quite straightforward. On the left-hand side, what you have is a motor, an electrically driven motor that takes renewables off the grid or cheap offshore wind electricity off the grid. That drives a motor, that drives a compressor. The compressor pumps air underground into a salt cavern. The salt cavern is solution mined from salt deposits at a depth of 1 kilometer, a volume in the cavern of 500,000 cubic meters. The height of the cavern is 95 meters and the diameter of the cavern is 75 meters. And that size of cavern can comfortably provide 12 to 14 hour storage. 2 caverns, I can get up to over 24 hours. When I want to redeliver that power back to the grid, when we have low wind events, let's say, and we need to bring that stored renewables back onto the grid, what we do is that the air is released from the cavern. As it's been released from the cavern, it cools, and thus we have to preheat the air, and we use renewable hydrogen, and that's the proposal for the innovation in this technology. And that can provide 320 megawatts of storage power delivery back onto the grid, and it enables the management of wind over long periods of time, and that's its advantage. Capital cost 320 million euros, so that's 1 million euro per megawatt, and it could take 3 to 5 years to develop these projects. And our flagship project in the Netherlands is the leading project in Europe using this technology. Move to the next slide. The benefits, well, it can do a number of things. One, it can enable much higher levels of renewables, reducing the curtailment of renewables. As a consequence of that, essentially cheapening the integration of renewables, it reduces wholesale electricity production costs right across the system. And that can translate into cheaper bills for consumers and all industrial users of power. It enhances the security of supply of the system. And as a consequence, or a direct result of the enhanced security of supply, is because it's enabling more renewables, because it's maintaining the system security, you're able to actually turn down and turn off fossil fuel plants. The overall impact of that is significant reduction in carbon. Based on the validation by the European Commission of the 320 megawatt project in the Netherlands, its total socioeconomic value based on those indicators is 2 billion euro based on the 2019 assessment. That is 2 billion euro, which is the aggregated impact over a 35-year operating period discounted back to 2019. When fully built, the value was 5 billion. In a traditional revenue model, discounted cash flow at 12% discount rate, the market value at financial close ranges from 100 to 200 million. The market failure is very significant and is a huge problem in getting these technologies to market. If you come on to the next slide, which is the last slide, which is what we're here to assist or get your assistance with today, is addressing the financing gap. At the early stage of initiating these projects, we're able to secure grant funding, we're able to secure seed capital from the more entrepreneurial visionary investors. That gets us through the first series of major milestones on the project that brings us to a point where we need additional investment to match fund the grant, because you will only get 50% of the grant. You have to match fund the balance. And that requires a market financing solution. We end up being caught between financial close, achieving the permitting of the project, and moving the project into agreeing the EPC arrangements and the long-term contract with customers that's going to pay for access to the storage. And investors like to see a very hardening of the business model at early stage in this process. And we can achieve that by entering into long-term contracts with customers. These will be utility scale customers, but we still bear the permitting risk. The EPC risk is manageable. We've got major entities in the market such as Siemens and Mitsubishi who can provide this system. But permitting risk is, I believe, overemphasized in the risk assessment because these sites are brownfield in nature and it's a highly manageable risk. We end up in a no man's land of this 24-month period where you're having to tread water, finding various plasters type solutions for your financing problem. And that 24-month gap is pervasive right across the energy transition when it comes to technologies that have to be brought to market, that have significant revenue streams that can point towards that are verifiable, can secure contracts, but are unable to get through the development phase of the project. And that is, as I said earlier, a pervasive problem. I'm very much looking forward to the input from colleagues and from the audience today and tomorrow in terms of the workshop sessions and seeing what the solutions might be to address this problem. The energy transition requires these technologies and a whole range of technologies that have to be greenfield financed, and there's no getting away from it. The energy transition won't happen and these targets will not be realized unless this problem is solved. So thanks very much for your attention and very much look forward to the various discussions. Thank you again.
Keith, thank you very much. It's a fascinating project and you make the point incredibly well, and we'll get into a lot more detail on that over the course of the next day. So Richard Peers, back with you now, and I'm going to hand straight over on the call to Maya Hennickes. Maya is the ESG lead for intermediaries with the EBRD, and Maya is going to talk to us a little bit about the role of that organisation and take us through what she's done in terms of bringing finance to development solutions in social and environmental areas. Maya, welcome to the call today, and over to you.
Thank you, Richard. Hi, everyone. I'm on the phone today, so you won't see me, but hopefully you can hear me well. My name is Maya. I'm in charge of a team that looks at the environmental and social risk analysis for our investments in financial institutions. So from that lens, I think I can speak to you both as an investor, because obviously as EBRD, we invest heavily, particularly in the types of projects that Keith has mentioned, like renewable energy, etc. But I also work with our commercial bank clients all over our countries of operation and help them in setting up their, in my case, environmental and social risk management systems so that they can finance better projects and evaluate the risks better. My particular and personal lens, as mentioned, is of course the non-financial risk assessments and management. However, I'll share with you a little bit a more general view, including also, of course, the views, or the not particularly the views, but let's say the perspective of other parts of our bank, because I think to understand why we're not where we all collectively would like to be, it obviously takes a look at various areas. I'm going to go to the first slide, and I will not bore you with a long institutional presentation. What I would like to show you just very briefly is what the EBRD is, because I think it is important to understand what we are and what we're not, so that we can then understand why certain limitations maybe occur in the way we finance, and also what kind of requirements we have to comply with. So we are a public bank, a multilateral development bank. The European Bank for Reconstruction Development was established in 1991 after the collapse of the Soviet Union, with a very clear mission which was to transition the former countries of the Soviet bloc to open market economies. We have since expanded a lot. We're now working and doing projects not only in Central and East Europe, but also Central Asia. We're all around the Mediterranean. We have big projects and big exposures in Turkey, in Greece, Cyprus, and on the Northern African continent. So we're also in Morocco, Tunisia, Egypt, and so on. So we have a very varied region, which also from EU countries to countries that are really at very much earlier stages, perhaps of development, if you want to call it that way. So I think that is another aspect that may be relevant to the way we finance, and sometimes where we cannot finance, even though we would like to. It's also, I think, important to understand that our shareholders are governments, precisely 69 countries, and the European Union and the EIB as institutions, which means that we have to comply and also, of course, satisfy the interests of a very diverse shareholder group, however, all of which are public institutions. We have a capital base that's paid in by those countries. Some of our capital is actually paid in, some of our capital is callable. That means that it stays with the government, but we have sort of an envelope that we can come to if and when needed. And what's also important, I think, to know is that we have a AAA rating from all the big rating agencies. That will be important maybe also to understand the risk appetite that our institution has, because we have a very strong mandate, or a very strong, how shall I say it, interest from our shareholders that this AAA rating be maintained. So that has obviously its consequences in the risk appetite that our portfolio can take on. So this just for background. I would like to move on to the next slide, please. And I think you can already see without even reading the bullets, and Keith will probably sigh when he hears that, there's a lot of things that we do finance, and then there's already a lot of criteria that we don't finance. So on both sides, for an investment to fit into our investment appetite, a lot of things have to come together. And so in our case, a project has to be obviously in one of our countries of operation, the countries in those regions that I outlined. As a development bank, we're obviously not investing in countries like the UK or the Netherlands or Germany or Spain. We are investing in countries that are mainly emerging markets and developing markets. A project still has to have good prospects of being profitable. So while we're a development bank, we function like a commercial bank in that sense. So we look at credit risk analysis in the same way as a commercial bank would do that. And we have to provide all our loans to private sector institutions at market conditions. Because, of course, if we did not do that, we would be outcrowding the local capital markets. And then again, that would be sort of defying our mandate. So in order to achieve that, we request that the project that we finance, they already have a significant equity contribution in cash or in kind from the project sponsor. So they have to be financially sound. At the same time, we're asking for a lot more. We're asking that the project benefits the local economy. We have a very detailed matrix that we call the transition impact matrix, where for every project that we're intending to invest, we evaluate upfront, and then of course there's also an ex post analysis if this has been achieved, what the impact of that project will be to the local economy, to the capital market, to the industry sector in question, and so on. We have very stringent environmental and social standards, which is obviously my area, that the project needs to satisfy. It does not mean that it has to be in full compliance at day one when we enter the investment, but if it isn't, then there will be a very detailed environmental and social action plan, which is part of our contractual agreements that guarantees us that the project will be brought into compliance with our environmental and social standards. Lastly, we can never finance a project alone, so we cannot stem the financing of any project by ourselves. We always need partners. We can only ever do 35% of the total project cost, which means that we partner either with other development banks, such as the World Bank's private sector arm IFC, or of course with commercial lenders, and then we put the syndication package together for that project. And I'm going to move on to the next slide just to give you a quick idea also how sometimes narrow our the loop is for a project to be able to be financed by us, because we have also very clear exclusions. Some of them are of a political nature. When the EBRD was founded, it was just decided that certain sectors, you can see that here under the first bullet of sector exclusions, we just do not want our money to go towards. And then we have an environmental and social exclusion list where we exclude projects that we do not want to finance because of precisely environmental and social considerations. And since we have updated our exclusion list with the with our own environmental and social policy, which was updated last year, we, for example, also excluded coal, we've excluded upstream oil projects. So we're taking decisions on not further supporting certain projects because of environmental concerns. That obviously, for a project to happen with us, it needs to fit into this gap, right? And I admit, and I really feel Keith's frustration as well. I think our standards are pretty high, and there's obviously a good reason for that. It is very important for us to implement, for example, on the environmental and social side, the highest international best practice standards that there are. But it also means that there is obviously a practicality aspect, that some sponsors are not maybe easily able to achieve those thresholds or these bars. So it's yeah, we try to work with them, and I'm going to come a little bit later also to some sort of solutions what we do in those cases. So just maybe in summary, and I'm going to move on to the next slide, to put all these pieces of the puzzle together, we have a lot to cater to be honest, as an investor. So on the one hand, we have very diverse shareholder interests. We have to come always up with a decision that's palpable to the majority of our governments that are our owners. We have to make our credit risk colleagues comfortable with the project. Again, we have a AAA rating that needs to be maintained. We need to have a balanced portfolio, so we have all sorts of internal considerations of not overexposing on any given sector, any given country, any given company, maybe particularly, or a financial institution, so that our portfolio stays balanced, which is important to us, obviously, from a credit risk standpoint, but also from a standpoint of a development bank, because, of course, we want to be useful to all our shareholder countries and not favor some of them. Then again, environmental and social requirements. We do the environmental and social due diligence for every single project ourselves. It's a process that even our bankers often say, oh my God, it's too much, too long. We understand that, but it's for a good reason. And we think that the outcomes justify the journey. So we understand it's sometimes a hard bar, but we're also, I think, we're trying to be very supportive in achieving this bar by, for example, providing technical assistance that can help a client implement certain environmental measures or close certain gaps. Then, of course, we have a lot of requirements on the compliance and corporate governance side. That's, depending on the market, has more or less relevance, of course. But I just want to mention that there's another standard that also needs to be achieved. I've already mentioned the transition impact, so we need to really prove for every single project that we're still true to our mission as a development bank or a transitional development bank, and not simply, let's say, with the same intent that maybe a commercial bank could have. So for us, the overall impact on the society, on the local economy, on the capital markets, etc., is very important, and it needs to be very carefully proven for each project. And then we also make choices, right? We have impact goals set for ourselves. For example, we have the green economy transition approach, which basically was the goal for ourselves to set a 40% of our new approvals on an annual basis as of this year should go towards what we define as green projects. And because we are also a very big institution and we have a lot of staff working, let's say, on green topics, whether that's from a climate change angle, from a technical angle, from an engineering angle, from a finance angle, from an E&S risk approach angle, we have a very refined approach and what counts under GET. So again, there's a lot of high bars for us. We're actively looking for those projects, and we want to move on, and we want to advance, and we want to expand on our percentage that we put towards the green projects. But I also see from the day-to-day and the reality that it's not always that easy to actually find those. And again, they need to be green, but they also need to satisfy everything else, right? So sometimes we have here conflicting interests. I can maybe very briefly an example, which is not from the EBRD, it's from a previous employer that I worked for, which was also a multilateral development bank. But I've been closely involved with a lot of wind projects, for example, which had a great environmental record, but severe social issues. And so the overall result, let's say, was not satisfactory because the social issues that were maybe created or exacerbated or brought to the surface by us and our co-financiers sort of investing in this project, giving visibility to this project. Sometimes, you know, you have conflicting goals, even though it seems very easy. Oh, this is a green project. It's a climate change. It's a mitigation project. But there can be other concerns here that are not that easy to satisfy, like, for example, on the social side or on the credit risk side or on the compliance side or whatever that may be. I'm going to move on to the next slide. Just I know we're going to go into this in the workshop sessions later, but just to give you a very brief, maybe a little appetizer on things that we've been working on, and as I will say, maybe also collectively the development bank community at large, because obviously, as I said, we have a little bit of an extra challenge vis-a-vis a commercial bank, that we have to satisfy a very particular set of shareholder structure, but at the same time, that also can be a great strength. And in our case, I think the great strength is we have obviously governmental buy-in, so we can do projects that are very robust because we know that the countries where we're investing in those are fully on board because they sit on our board, and against their explicit approval, the project cannot be made. We also have access to public funding, of course. I mean, our capital is from public sources, but we also have access to additional public sources such as grant funding, for example, which can help. And how can this help? I think, and Keith has talked a lot about it in direct and indirect ways. I think the de-risking of the investment at the end of the day is the key to unlocking this. We obviously have two sets here. We have perceived risks, and I'm sure Elena can talk a lot about this as well, where perhaps, especially commercial banks, they may not have the right kind of data, or our credit department for very new or very innovative technologies, like Keith's, for example, we may, or like the random credit department may not quite know how to evaluate that. So, of course, there are perceived risks that may or may not be real, but if the financing institution doesn't know or has certain perceptions about risk, then we're already facing the first hurdle, right? So again, data and transparency, I think, is the first important segue to addressing perceived risks, and we can talk more about that later. And then there's obviously real risks, and I think sometimes because we're a multilateral development bank, we can, by our sheer presence, we can address some of the real risks, country risks, maybe political risks, because we're obviously owned by the government where the project is being made, and so we have the government's approval. We also enjoy preferred creditor status in our countries of operation. That means that in reality, when a financial crisis hits maybe, or if other privately financed undertakings are not serviced anymore, the multilateral banks in, I would say, this is not an empirical number, but probably 99% of cases always get paid back. And so that helps also to provide comfort to our co-investors, that could be commercial banks. Then, of course, by going through our strenuous environmental and social process, for example, we also provide some sort of a set of approval or stamp of approval that our clients appreciate. And I think that also helps with the both with perceived risk and also with real risks. Reputational risks come to mind, and obviously other non-financial risks from the environmental and social spectrum. We've worked a lot with what we call blended finance. These are basically instruments where we try to reduce the cost of such a financing structure by using public funds. And we try to do that by applying a principle that we call the minimal concessionality. That basically means that we're not just throwing free money from grant funding from governments at projects, but that we try to really find where is the lever between the minimal amount needed to lift a project over the hurdle. Okay, sometimes that can be, like he said, an early investment grant that can help the company, for example, to do a robust feasibility study, or let's say for a geothermal project, guarantee a first number of drillings so that they can prove resource, whatever it may be in the early stages. It can also be providing a guarantee. From a financial standpoint, is a pretty cheap instrument, yeah, because we don't actually have to pay out unless something really happens. We can play with risk subordination. In my previous job, we, for example, fundraised a big fund for climate financing from a major government, which we could, which funding we could use to absorb the first risk in a structure. So they had more risk appetite than we could take for a specifically defined set of climate-friendly projects. Then, of course, interest rates. As EBRD, we cannot provide concessional interest rates because, what I mentioned before, we're not supposed to crowd out the capital markets. We have to be at market rate. But we are playing with certain instruments that in the overall scheme, sustainability-linked loans come to mind, social linked loans come to mind. We can perhaps do little incentives that we can build in these kind of projects. And then, of course, we can provide technical advisory that often helps to address maybe technical gaps or gaps where a simple study is needed, a biodiversity study for a wind project, for example, where we can close those gaps and get the financing community comfortable with the project. And that all then creates, obviously, an environment where a project, for example, a first mover project that hasn't been done before, can happen, and it creates a demonstration effect. And then usually other financiers come in behind us and replicate those projects. Yeah, I think I'm going to finish here. This is just a bit of a group of ideas that I think we can all expand on in the group sessions. And I think we don't have the perfect solution yet. And as you've seen, we need to really tighten the screws on many, many ends. Keith mentioned, of course, one of the main problems, and this is nothing new, you all know this, is, of course, as long as we're not pricing the externalities in, the financing will never be really address the market failure that Keith described. As long as we don't have a price on carbon, of course, his balance will look very differently than if there was. So there's things that we can do, I think, at the policy level. There's things that we can do at the commercial financing level, there's things that we can do at the in-between for an institution such as us, between public and private. Yeah, the solution has a lot of aspects, and it's not easy, and it's not done by just addressing one particular point. I think it's very multifaceted, and I look very much forward to getting lots of ideas from my fellow speakers, but of course from the audience as well, and how we can collectively to tighten the screws and move us all sort of closer together into a sphere where we can really unlock the need for financing, which is obviously beyond clear that we do need to do that. And I'm handing back to you, Richard, with that. Thank you.
Maya, thank you. That's a fantastic, honest and forthright exposition on the challenges that we see, as well as the opportunities and the good work that you're doing. I mean, you touched there obviously on the de-risking and the need for data. So I think that's a perfect time to bring in Elena from Refinitiv. Elena is head of ESG propositions. She's also part of the technical working group within the EU taxonomy, so has a great understanding of this area. And I'll let Elena take us through this final session before we go to Q&A. Elena, over to you.
Thank you, Richard. Maybe just a couple of words about Refinitiv as well as tech to set the scene. And then I think I want to make a couple of statements about the industry, the space we're in, because that underpins some of the challenges that we're facing as an industry, and then moving to the problem statement. I do represent, I guess, two organizations today. The first is Refinitiv, and we power the global financial industry through data technology and expertise across different customer communities, primarily trading, investing and advisory, wealth management, enterprises, and risk management. We were spun off from Thomson Reuters 2 years ago, and the financial and risk business was created into a new company called Refinitiv. So we have more than 100 years of legacy, but a relatively new brand in the market. I'm also a member of the technical expert group on sustainable finance appointed by the European Commission back in June of 2018. The primary mandate and purpose of the establishment of this group with experts from the private sector was to provide technical recommendations and guidance to the public sector, to the regulators, on the implementation of the action plan on financing sustainable growth. This action plan was announced earlier in 2018 to support three main objectives around reorientation of capital towards sustainable investing. The second is mainstreaming sustainability into risk management, and the third is around improved transparency and long-termism. A number of work streams were supported by tech, one of which is the European taxonomy, and we do think that that's a very good use case to use in today and tomorrow's session on data and reporting. I also want to make another point, which is around the financing gap. We don't have a problem of money. We don't have a problem of capital, as there is enough to finance the transition to a sustainable future. However, the capital is not channeled towards it at the scale and speed that's required. And there are different reasons for that and different challenges, as some of the previous speakers already touched on. And I would probably, broadly speaking, classify that the problem is really structural and definitional. We speak about ESG and it's just 3 letters, but actually it does mean so many different things to so many different people. So although at the surface it may seem rather straightforward, it is a lot more complicated to come up with industry agreed definitions that work for different stakeholders and different groups. Even when we look at things like green assets, green companies, green activities, it is not very simple to agree on consistent definitions, as there are different shades of green in this example. But this is one of the foundational blocks that are so important to be put in place to facilitate that shift in capital that's so much needed. The other point that I think is very important to make is that we're on a journey. It's a journey that we've been on for a number of years, probably a couple of decades now, but it has picked up a lot of momentum only in the last couple of years. And this journey will be continuous journey for us, for our societies and our sector, and all industries in the global economy, frankly speaking, for the foreseeable future. So we need to appreciate that. We need to appreciate and accept the fact that we're not going to know everything. We're not going to have all answers. We're going to be faced with obstacles that we need to overcome, and there will be trial and error. But this actually creates tremendous market opportunities. And that's the area that the market should focus on, not so much on the challenges, and use the challenges as excuses to delay actions. What we've also seen in the last couple of years is an explosion in ESG regulation, broadly speaking, but also regulation around disclosure and transparency. Since 2015, regulation around ESG topics and amendments to such regulation has doubled. And Europe accounts for over 65% of ESG regulation. But the key main drivers for this explosion is really the 2030 Agenda and the United Nations Sustainable Development Goals, as well as the Paris Agreement, and the sea of material and insights and information produced thereafter on what does that mean, what this agenda means, how it should be financed, how quickly it needs to be executed, and thus putting the models, the frameworks, as well as providing the industry with tools on executing that transition and that shift in capital that's needed. However, the challenge with disclosure regulation is that it remains to date, and hopefully that's going to change in the future, but as it stands today, vastly voluntary. It's limited in scope, and it is highly qualitative. So what that means is that the content produced by different market participants, by investors or by companies, tends to be narrative in nature, tends to be difficult to compare, and selective. For example, companies will choose to report on the issues that they believe are relevant for them, or they believe they make them look good. So it is selective, and it's highly unstructured. And that alone creates lots of downstream challenges for users of this data. And I also think it's important to think about the value chain here. Companies rely on suppliers. So we have reporting by suppliers. Then we have the company reporting their obligations to their stakeholders. And then we have the reporting by investors, and the obligations that they have to their stakeholders, as well as compliance obligations, more and more compliance obligations that this new regulation is creating on different market participants and groups. So it's good to think about these three groups and where the problems exist and what can we do to overcome some of these problems in the interim until long-term solutions are put in place. So I guess I've been talking about the challenges, but it's very important again to make the point about the endless opportunities for innovation, for differentiation, and for competitive edge that this landscape is creating in the market environment. As mentioned, I think to to make the conversation more tangible, it's good to look into a specific use case, and a good example is the EU taxonomy. The EU taxonomy regulation is the foundational block of the sustainable finance agenda in the EU, but hopefully beyond. The work that's been going on in Europe should and hopefully will be implemented and adopted at scale internationally as well, because that's how financial industries work and financial professionals work. And we've seen this regulation, although it is work in progress, getting a lot of market momentum. And I do foresee that this will be the case in the future. The EU taxonomy is a classification tool to help investors, to help companies consistently determine whether an economic activity is environmentally friendly and sustainable or not. It provides very specific technical thresholds on the environmental performance of the economic activity to be considered compliant with the EU taxonomy. It is in development, and it has covered two activities, two environmental objectives from the 6 of the EU, namely climate mitigation and climate adaptation. And the delegated acts on these two environmental objectives are expected by the end of this year, with 12-month time afterwards for actual implementation. And for the remaining 4 environmental objectives, delegated acts are expected 1 year later, by the end of 2021. And once in place, what the EU taxonomy regulation will require is for market financial professionals, financial institutions, to report on taxonomy compliance across their portfolios, across their allocations. So as you see, it is a multi-year journey. At the same time, what we're seeing from our customers is a very strong demand and desire to start implementing this regulation and understanding the implications on their portfolios already now. So we have an immediate market demand and market need and a challenge to solve for. So I guess in terms of formulating the problem statement of our session for these 2 days, is on one side we see the emergence of regulation, and then on the other side we have significant data gaps, and it will take time until those data gaps get closed, and these time frames will range from different regions and across different activities and asset classes. So how can we empower and inform investors in closing that gap and not having to wait until disclosure is mandatory and made available by all companies, so that they can assess their current exposure and be empowered to increase their current exposure to green economy and to finance the transition urgently, which is what is really required. In terms of some of the problems within that bigger problem statement, we have issues around multi activities and product portfolios of companies. So we have primary activities and secondary activities, and trying to assess the greenness of the full portfolio of products and services that companies offer to their customers. Data availability, of course, outside of the EU of different assets and activities that are of interest to investors. Assessment against the technical thresholds, because currently what exists in the industry are very different definitions with little alignment. But if reporting is to be done at a portfolio basis, those data points across asset classes and across holdings of a portfolio need to comply with a consistent definition. So different components into the problem that potentially we can dig into deeper in the workshops tomorrow. And of course, I mean, one side is this company-related information that we expect companies will be making available to their stakeholders in a self-reporting form. But there is a whole new data set emerging, like satellite data, supply chain information, or broadly defined as alternative data sets. And how can these two be brought closer together to close the gaps in data that exist? Now, when we talk about data and bringing data sets together, it's very important to think about, well, what data sets, how do we obtain it, how do we get it, how do we connect the data, normalize it, and enable reporting, because ultimately that's what's the obligation of investors and financial professionals to comply with the EU taxonomy regulation. And how do we maintain a high degree of confidence in this information through audits, through different verification services to solve the problem that the investment community is facing? But ensuring that this solution doesn't deviate significantly from actual reported data that will become available at a future state. Because if at a later stage, the information that's become factual is vastly different from what we've been able to so far in an interim basis is different, it can truly fatally hurt adoption and trust in this direction of shifting capital towards the green economy. It can hurt the trust in taxonomy and taxonomy-related solutions available in the market, and can hurt the whole economy vastly. So we need to find the right balance here. I think that that's probably a good overview and enough information for today. Happy to go in more detail during the Q&A, the panel discussion today, but also look forward to your thoughts and insights in tomorrow's workshop session. Thank you, and back to you, Richard.
Fantastic, thanks, Elena. That's really helpful. And you know what we've heard there, remember, is not just presentations, but you know our folks are laying out the challenges which we're going to take into the workshop. So some of my questions will not be quite the normal ones you might ask, because what we're trying to do is to sort of drill further into that, as Elena was implying, so that we can make sure our teams on the workshops tomorrow have got as much armament to try and solve those challenges. We did a speed dating process with our attendees last time when we actually did the event physically. But we've got some great questions as well, actually, on our Q&A panel, which I'll come back to in a moment. So what I want to do now is just really kind of, let's see if we can summarize this a little bit with a few questions, and we'll capture this as well. But going out to all three of you, feel free, I can see you on my console to put your hand up. If you try and break it down, perhaps I'll go to you, Keith, from your first sense of the process or the data or the friction, whatever, if you really try to find the essence of it, what do you think is creating the challenge that you described so eloquently in the first presentation, and that you've heard a response for some of the reasons why from both Maya and Elena? What do you think we can do to solve this?
Yeah, thanks, Richard. From a long time raising capital into projects, when I consider the main point of friction, I actually believe it is to do with the industry's capability in assessing development risk. And I also, that's related to in not having experience in properly categorizing development risk, and even being able to quantify it. In particular, the projects that we're developing, they are on brownfield sites, which have a precedent in terms of proven salt cavern storage, in terms of proven permitting on the site for large-scale industrial facilities. So there's an ability to quantify these risks, but the availability of capital is not there. It will sit there at financial close and is happy to come in at financial close or prior to financial close. I think investors get into this group think around a binary risk in terms of permitting. So will permitting happen, yes or no? Now, the silent question in the Netherlands, Nurion, who was our partner, who was formerly AkzoNobel, 100 years experience in creating underground caverns for various uses. They've never failed to secure a permit for an underground cavern. But notwithstanding that demonstration of the capability in securing the permitting for a similar facility, investors still get caught by what they're allowed to do and what they're not allowed to do. Maya touched on what EBRD's limitations would be. Actually, a good suggestion made in terms of guarantees, which I was quite interested in, that guaranteeing risk has to be a cheaper way of allowing capital to flow. So I think the main friction point is between, it's a capability question, being able to assess development risk and understand it and be able to price it accordingly. Against the funds themselves don't have the remit to invest into development risk.
Yeah.
And so we're caught in the middle.
Nicely captured. Maya, your response to that in terms of, the same question really around sort of frictions processes that we need to focus on in our workshops to try and unblock. If the question comes back to the banks, it's about your risk models, your decision trees, your groupthink. These may be bad words, but what do you think about that? Is that the right area as well?
Yeah, I agree. I mean, of course, my colleagues in credit risk, they need to have very good understanding of the project and of the commercial undertaking of the project. And if it's an innovative technology and a technology that we have not invested in ourselves yet, they of course struggle to evaluate that. So hence, here again, there's the need for rock solid data that can, I think, help unblock on that front. Then, of course, we're going to look at all the other things as well. The environmental and social risk management system. Again, if I, as the E&S officer, have never done such a project, I need to get comfortable with it. And this is a lot of questions that I would ask, and it takes some time. And I think we need to check, we need to really sort of understand the project well and be comfortable that the environmental and social risks can be managed of that project. And so I think from us as a bank, we need to go with a very clear request for information, of course, to the project developer, so that we can gather the information that each of our internal groups need. And then I think, of course, on the impact side, I would say a project like Keith is quite an easy sell, of course, because it's quite easy there to show sort of the positive impact. So I think here that probably in most of the projects we're talking about renewable energies, etc., innovative technologies for clean energy, etc. On that side, I don't see that many problems. I think, yeah, absolutely. I think we need to increase the transparency. We need to work on the data availability. We need to work on or with the potential project sponsors so that their type of information matches my information need. And I understand that can sometimes be burdensome, but it's just not really something we can say goodbye to. And then lastly, I think, yeah, we need to look at really a bit like brave and new models. Like, how can we finance something where the old plain vanilla loan structure just doesn't work, and see what other schemes can we come up with, whether it's a guarantee, whether it's a mix, whether it's a mix of mobilizing, I don't know, EU grant funding and applying it at the right moments. I mean, I think we need to think creatively for all of those projects.
Yeah, thank you for that. And Elena, throwing the same question over to you, but then taking it on with the thought about, if it is about evidencing the data and having that data in the hands of the risk professionals. I suppose one of the things that you touched on was that, of course, the world has historically been looking at over its shoulder, rearward, at the data from disclosures, etc. But in the modern world of alternative data, we're looking at data which is coming in real time, coming in hot across the planet. How do we sort of start to change that stream of data? And it's a harder question. How do we then bring that into the risk professionals' culture and processes? I don't answer all of that. That's a tough one, but pick it up from us from there, please.
Yeah, we can certainly go into more detail of this tomorrow. But broadly speaking, I do think that what is required first and foremost is accounting standards for ESG, for non-financial data. Second is a lot of education, because the topics and the issues covered in the broader sustainable umbrella are not intuitive and do not use terminology which is easily understood by the financial industry, and really pushing us to break old habits and ways of doing business. As Maya mentioned, we just need to be a lot bolder and embracing innovation and looking for new venues and new ways to have more impact with our decisions, with our capital. I think specifically also what has hurt the industry in the past a lot is commercial interests, as it's been industry-led and private sector-led. So I guess it's important to forget commercial interests for a moment and focus on the primary objective at hand, also tomorrow during our workshop, which is transforming capital markets to finance the sustainable agenda, the future. As this is the only way to have more resilient models, business models, economic models, and sustain economic prosperity. So there is a much bigger mission here that we're trying to fuel and empower through data to help it move in that direction as quickly as possible.
Thanks, Elena. Let's just pull in a couple of questions from our panel, from our audience on the Q&A panel. Maya, one for you. Which green projects have the EBRD invested in this year, if you're able to mention anything to us?
So we invest very broadly. We invest obviously a lot in renewable energies. We have done a lot of wind projects, solar projects. Energy efficiency is also a big focus of ours. We also do sort of green in other areas, for example, ecotourism, green agribusiness or sustainable agribusiness. We also do through financial intermediaries. We give them, for example, on lending facilities to specific green users. So, for example, energy efficiency in mortgage lending. So we really try to do the green as much as possible. We had about 46% last year, 2019, of all of our financing was for green projects. So they go across all sectors, really. Green infrastructure as well is a big one.
And when you look at the challenges we've laid out here, okay, have you got examples of when these things have come together well? Essentially, the investee and the investor ambitions, the risk committee, the data, etc. Do we have any good examples, or is it just better than the rest and still a long way to go?
No, look, I mean, I think there's always moments where I think you can push the boundaries a little bit. I recall very fondly a project. This is not from the EBRD. This is from already about like 10 years ago. But where I was involved in the financing of the first large-scale CSP solar project in the northern part of Chile, in the desert, and there were none. The resource was obviously ideal. There were a lot of off-takers because there's mining companies all around that were glad to take off that, but it just had never been done. So the commercial banks weren't quite ready to evaluate that risk, and we put together what would now be called a blended finance structure. We didn't call it that back then. And it really became sort of a first mover demonstration project, after which 4 or 5 very similar projects in very close time proximity popped up, all in the Atacama Desert of Chile, doing the same thing. And I think that's exactly what, when you say that's exactly the way it should work, right? Because you can use some sort of public money and then a lot of private money follows after, which is exactly the leverage we'd like to have. There's other examples, I think, where we can take examples maybe from the, can give you maybe another example that I particularly like very much. I'm a little bit proud of from just recently. We worked, for example, in Greece with the privatization fund, who has a large envelope of infrastructure assets, and of course they're not investing, right? They have to privatize, they basically sell them off. So how can you incentivize them to increase sustainability in such a portfolio? Well, we brought together the ideas of more digitalization, data flow, and created an app for them, which basically functions like an environmental and social digital evaluation system, so they can evaluate their assets now, and that gives them access to a whole new set of potential investors that are interested in environmental and socially robust investments and in that kind of data, but that just they weren't able to provide that data to before. So yeah, sometimes it was a very small project, but it can have like a little bit of impact if you, if you try it out and then you try and scale it up afterwards, of course.
Yes, exactly. I think it's these experiments and then scaling that creates the new model, the new culture. We've got about sort of 10 minutes or so, and I've got a bit of wrap up to do. But Keith, there's a question for you from our audience where they were asking you, obviously briefly, if you would, explain some of the composite parts of the discount factors used by financiers that reduce the value so much. Is there a specific thing which is a single factor which is driving the value down? I mean, if it's too much, we can take it offline, but if you can give it a quick go.
Yeah, no problem. An excellent question. The discount factor can be as high as 15% on the revenue streams that are forecast from the storage unit in the market. So that is taking the project, forecasting its revenue streams and discounting them by 15%, which is a very high discount rate. Now, the cost benefit analysis that is conducted using the methodology set down by the European Commission has a social discount factor of 4%. So the differences are stark.
Yeah.
And remember, this is a 35-year operating life project, and it involves the ability to capture a number of revenue streams from several market segments within the power market: ancillary services, energy trading in the day-ahead market, intraday market, and balancing market. So you have this revenue optionality, and the use of a discount factor, a single number, that is to represent all risks into the future, several revenue streams. It's so oversimplistic. I mean, it truncates the entire value. So we're being asked to fit into a wind farm financing model that was developed, what, 2 decades ago for subsidized wind farms.
Yeah.
And when we talk to institutions, what they ask us is, yeah, well, look, we understand that, we understand the need, we know these projects need to get away. Can you fit your project into a wind farm financing model? And then I can bring it to investment committee.
Yeah.
And I had that conversation as recently as before the pandemic broke out. So
perfectly caught,
yeah.
And I think that's what we have to bring into our next session. One quick question from our audience, and then one more to all of you, and then I'm going to just wrap up for us and set us up for tomorrow. From Amy, he asks, or she, I beg your pardon, market failure is one of the largest risks that borrowers wouldn't be able to overcome, and that's not as easy to gauge as country and political risk. How does the EBRD deal with the changing market situations on the ground? Another tough question, Maya, for you.
Oh, yeah, indeed. Well, we have a local office in all of the countries of operation, with obviously a head of office, local staff, so we know the markets very well. We have our economist teams that follow the markets for each of our country very closely, do usual macro and microeconomic analysis, etc. And I think we just, we deal with it like any other investor does. We have, of course, as I mentioned before, we have the advantage that our projects are always approved by the government. So in general, at least that eliminates to a certain extent, or at least that helps us usually with local conditions to a certain extent. But of course, it does not provide a blanket protection against market risk specifically. So if markets fail, we have to deal with it as any other investor as well. But we obviously, again, knowledge is key, right? So we observe our markets very closely. We are in those markets. We're not just looking at them from London. We have an office there. We have our economists and our finance specialists, our bankers in the countries. And so we have a very close loop, I would say, of knowing what's going on and then being able to manage those kind of risks, hopefully sufficiently early.
Very good, thank you. Quick question to everybody as a last one to run around. I mean, to a certain extent, we're talking about the investors and the investees. We're talking about the models, perhaps the friction and the processes, not keeping up to date with the needs, and obviously the climate crisis. Obviously, it's broader than climate. When we look at things in other areas, such as the Competition Market Authority, which decided that it needed to sort of change things in consumer banking. It brought in areas like fintech and open banking to get sort of data flowing and allow innovation and new players to come into market. Do we, in this market, Elena, do you think that we need more data flowing, more competition? Is that the problem, or do we just need to sort of harmonize what we've got? What could change this to sort of move things along faster? Elena?
I mean, I do think that there is a lot of data flowing in already. Clearly, there is more standardization that's required on this data, as well as a common place to bring it all together, to connect it, so that it's easier for investors to aggregate at scale. Because as Maya mentioned, I mean, they're able to do their own due diligence on environmental and social issues, but that's not the case for vast majority of the institutional investors out there. So they do rely on having access to reliable, connected, and easily digestible data sets that bring those insights at scale to them and flag the risks, as well as enable enough innovation to uncover where the opportunities and for investors to design unique and differentiated solutions and products to offer to the market. So I do think it's more a question of digitalization and solving the data connectivity and standardization challenges for users, more so than it is about letting more alternative data and more data flowing into the mix.
Keith, what if you were to sort of respond to a similar question, do you see, if there was a sort of two-sided marketplace with new actors, being able to identify your kind of project, as an exemplar and being able to put their investments in, I'm thinking of the way that peer-to-peer sprung up, the way that crowdfunding sprung up. Do you see innovations like this needed for you as an entrepreneur?
Yeah, I very much do, and we have been in early discussions, mind you, with a platform in the Netherlands that has allowed investors, retail investors, institutional investors take positions in projects, albeit closer to the financial close stage. But we are exploring how could we allow them come in at earlier stages into projects. And it's been very well received, because one of the challenges in getting projects away is not just the financing, it's also that you've got to bring local communities with you. And so if the local communities are invested into the project that's the right way to develop these projects, is to have them alongside you as an overall promoter of the project. And no better way than if they're an investor into the project. Interests are aligned, and I do see that as an innovation that is needed in the market. We need the sort of innovations we've seen in fintech brought into the energy transition. I would very much welcome that.
Well, sadly, time has got away from us, May. I can't bring you into that question. If we jump to the last slide, though, what I'd love everybody to do that's listening is to make sure that they, some of the joining instructions are always a little bit challenging on these things, and we did reinvent this process for this digital world. So tomorrow, if you haven't registered, you will be able to work with our great colleagues here and at least about 10 other great stars that have volunteered their time to help us solve these problems. Sign up for any one of these 3 sessions. You can download an app. The sessions tomorrow will be much more interactive because we'll be going through polling, Q&As, we'll be using whiteboards to sort of sketch out the ideas, we'll be bringing the audience in to bring their ideas vocally to the team members so that we can capture those on the whiteboards. So please do work with, Elena, Keith, Maya, myself, and the others tomorrow to try and, learn from these challenges, bring your expertise, help us come up with some solutions, and try and actually get something resolved. So it's our Apollo 13 moment, folks, and it's time to roll up our sleeves, download the app, and see if we can figure how we can put a round peg in a square hole. Thank you all so much for your time today. This has been our first digital, virtual, sustainable Finance.Live with Finextra and ResponsibleRisk. I hope you've enjoyed it. It'll be recorded and sent out to you subsequently, as well as some great editorial from the Finextra editorial team. So for us, for now, thank you very much. Over and out.